Welcome back. We're exploring the complex risk landscape and returning our attention now to how executives are responding to the environment. Still with me for that discussion is SHA Risk Specialist Business Head of Digital and Financial Lines, Simon Coleman. And joining us now is Underwriting Head of Financial Lines and Compliance, Tebogo Leshilo. Tebogo, let's bring you in here. Thanks for joining us. So before the break, we were saying that there has been this general increase in risk and awareness of risk because of COVID-19. But as the title of your chapter in this annual risk review that we're unpacking today suggests, while awareness is on the rise, risks are also on the rise, right?
So looking at the impact of COVID-19 from a risk profile, especially speaking to the exposures faced by directors and officers, they find themselves in a place where there's more onerous responsibilities as far as their management of any COVID-19 related exposures, be these related to their customers that are in their buildings, be this related to the performance of their companies from a financial perspective as they navigate the impact of the pandemic. So from the perspective of the directors and officers, what we also do need to take into consideration is the legislation around appointing a COVID-19 officer within any organization. This is to take a look at the risks and exposures relating to COVID-19. This individual also faces the possibility that should they be found of any wrongful acts or failure to act in the interest of their company or stakeholders, such as employees within the business, customers that may be coming into the workplace as well, they could face allegations of wrongdoing in that respect.
Simon, for an executive at this point, I mean, I don't want to be in those shoes. It must be an incredibly difficult environment to operate in because there's no precedent here. COVID-19 came and swept us all off our feet, really, if you look at it. But executives do have, or there is the potential for them to be held accountable for the decisions they are making. Do you see that starting to come to the fore yet?
I mean, we need to, again, just contextualize that directors have been falling foul of their fiduciary duties long before COVID. The Companies Act sort of pierced that corporate protection they had, the old days where you said, well, I'm in a PTY limited, so you can't touch me. My liabilities are separate from the businesses. But so we were already seeing an increase in litigation against directors who'd made bad decisions in running those businesses. And some of them you would have seen in the headlines pre-COVID. So that was already happening. I think where there has been a shift, of course, is, what would the director, or what could they have done differently to respond to the fallout from the pandemic? So it would be foolish to assume a director is going to be on the hook personally because the company didn't survive the pandemic because nobody was shopping or no one was staying in a hotel. That would be silly because they couldn't have done anything about that. But where there were things within their power and where they could have employed, say, alternative resources or pivoted the business, I'd say shareholders are definitely going to be looking to them and holding them accountable. I mean, why wouldn't you? If there was some way of saving the business and this individual who's running the company didn't do it or didn't see it, as a shareholder, you're definitely going to want to recover some of those funds that you've lost. So, yeah, the door is open and maybe COVID has shone a spotlight on the financial status of the business. So it is a wait and see situation now. We don't know. We haven't seen any specifically related to the pandemic, but it's, I mean, we're not even through it yet. We talk about it like it was last year, but we're still in lockdown in many parts of the country. So watch and see.
Yes, I think you're right to highlight there that missteps by boards aren't only as a result of COVID. Bad decisions were being made long before then, if we take a look at companies like Steinhoff. But Simon, some would argue that if you have the right board in place, they should be able to deal with anything. And that begs the question there, are companies doing enough to look into their boards in terms of background checks, lifestyle audits, and the likes of doing that due diligence to make sure they have the right people running those companies? And by turn, reducing the risk.
Yeah, I mean, you don't want to generalize, but when we looked at our survey, less than half of businesses did any kind of background check on directors. Now if somebody's appointed into an accounting position or is heading up the finance area, you would hope certainly that a criminal background check has been done. That's pretty important. But we still find that often directors are put into positions without the proper training. You might be the director on the board of a hospital, and you might be a doctor. You're a great medical professional, but you've got like this much experience in managing a business. So I think those things do need to be looked at, and regardless of the size of the company, businesses need to be thinking about who they put into those roles.
Absolutely. Tebogo, I was quite taken aback. I was reading the review, and in your chapter you highlighted that 8% of directors have been accused of wrongdoing in carrying out their fiduciary duties. Can you put that into context for us? For me, 8% felt quite high, but is 8% significant?
We've seen an increase in the number of allegations that have arisen against directors and officers. I think this is certainly driven by the climate in which we find ourselves, where there's certainly a higher focus on the financial position of companies, how it is that companies choose to respond to any type of negative events, those that may be in the press, such as on social media, anything that may perhaps impact their share price as well. I think we've also seen in some instances where some of those allegations against companies could come from inside of the company and not necessarily your external parties such as shareholders. In the instance where a company may have perhaps suffered some sort of fine or penalty by an external regulator, you could see claims brought against a financial director seeking to find out whether did they follow the correct steps in how they managed any circumstances that may come to light.
Then given what you're saying, are you seeing companies adequately covering themselves with directors and officers coverage?
From the results of our survey, I think we had about a 20% penetration rate, looking at the number of companies that do purchase directors and officers cover.
Okay, is 20% something that you're kind of happy with? Or?
I think large listed corporates, in that regard, there is a higher requirement based on the Companies Act and looking at King 4 as well for them to be covered. But looking at our smaller SMEs, there certainly is a very low level of insurance that is purchased at this time. The exposure that those directors face is the lack of protection on the company balance sheet, the fact that in the instance of directors and officers insurance, you're not necessarily only looking at settlements at the end of a process, but the policy responds as far as providing legal defense for your directors and officers in the event that there are allegations against them. So we certainly would like to encourage the purchase of increased policies, simply of increased directors and officers insurance for your smaller entities, especially considering that it's likely to be your personal assets that are at stake, not those of the company. So it should be best to provide some sort of alternative cover for yourselves.
There is a lot of risk at the moment, and executives need to protect themselves from that, and it's SMEs that really need to look at that. So where do you sit on this in terms of addressing that trust deficit?
I think what we need to look at is the culture that exists in a lot of companies, in a lot of industries as well, is looking forward. We historically come from a place where there's confidentiality concerns, there are concerns as well regarding competitive factors, and in the relationship with the insurers, we're not here as an adversary to the clients. I think what's important is for clients to consider insurers partners in protecting the interests of your company. So again, as Simon has mentioned, the amount of info that we have doesn't only enable us to better underwrite, but at the extent where there is a claim and an insurer is in a position where they need to defend the rights of your directors and officers, having sight of your audit and risk committee meetings is a further measure of the fact that the directors and officers are taking the correct steps in protecting the interests of the company.
So we have to leave it there, and I do hope that executives have heard you out and that their phones of insurers are ringing off the hook so that we can discuss this increasingly complex risk landscape and how companies can respond to it. But for now, both of you, thank you so much for your time today.
Thank you.
Great.
Thanks, Brandon.
Simon Coleman is the business head of digital and financial lines at SHA Risk Specialist, and Tebogo Leshilo is underwriting head of financial lines and compliance. And from me, Bronwyn Seaborn, it's goodbye for now, but stay tuned as there's lots more to come on Business Day TV.
33 countries, 75 innovative risk solutions, over 100 years of experience. It all adds up to being the largest general insurer in Africa.